Got it. All right, and we are live. All right.
Did you wait a second for everybody to get going, or want me to just kick it off? Or are you going to kick it off?
Let's give everyone a moment to sign into the stream.
Got it. I'll wait for you. Oh, yeah. It just popped up on my thing.
Yep.
I'll wait for you. Oh, yeah. It just popped up on my thing.
Let's see. We are live there. All right. Okay, we have a few people in now. Okay, I think we can get started. Welcome everyone. Welcome to a special edition on the iFlip YouTube channel. This is specifically for a niche group with whom we have a very special relationship, and we're just going to go over what iFlip is all about. So this might be review for some of you, but I bet you do get something new as you know, just like when you watch the same movie over again, you catch something new on a second or third watch. So stick around, and we'll take some questions at the end. So without further ado, I give you the CEO of iFlip, Randy Tate. Take it away,
Thanks,
Randy.
Aaron. Appreciate it, man. Super excited to be here. Really happy with some of the new developments and what's been going on in Flip. And I know we got a bunch of people on here tonight, or maybe watching this, that don't really know a lot about Flip. What are, who are we? What are we? So I'm going to try to do a couple of things tonight. One, I'm going to talk about Flip, obviously, but who are we? What are we? Just so that everybody knows, and we get this right out into the front. Flip's an acronym. It's the Financial Learning Information Platform. It is machine learning, pure AI. It's rare, in fact, non-existent in the industry, and we've brought it to market for the masses. And that's the whole idea of what we're talking about. And in an environment like the one we have right now, when you look at what's happened over the last year with people, down 20%, down 30%, down 50%, whether you're try to be in some kind of crypto thing, or whether you're a stock trader, or whether you just got your money parked in a safe mutual fund, you've been getting your rear ends kicked all year. And so it's a real big time for us to come out and start talking about it. So this is only going to be probably 30, 45 minutes at the max, but we're going to talk about a couple of things. One, who we are. Who is Flip? What does Flip do? Just a little bit more about us. We're going to really talk about investing for the average person. We're going to break down a mutual fund. We're going to talk about what does that look like? What does it think that's going on? What do mutual funds do? How much do they cost? And we're going to break some of the flaws of the system down. Then I'm going to show you guys the modern approach of Flip. Flip is something that's extremely new. You'll hear me say this multiple times tonight, we're the Netflix to the industry, and we got a whole bunch of blockbusters out there. And we're going to talk about that approach. We're going to break down what is AI. Most people don't know what it is. And in fact, most places where you see AI advertised is not AI at all. In fact, it's simply an algorithm. We're going to talk about that. We're also going to talk about some of the myths of Wall Street. I'll give you one example. It's a myth that diversification is a great tool to minimize risk. I'll say that again. It's a myth that diversification is a great tool to minimize risk. You've all been taught that. We've all heard that. Wall Street has pushed that on us for years, and we've just believed it because that's the way it always has been. So that is the whole concept of what we're going to talk about in the next 30 to 45 minutes. So let's jump in. Who is Flip? Well, we have a very powerful purpose. Our purpose is to empower every individual to preserve, protect, and grow their wealth. We spent a lot of time on that statement. We really wanted to put the words out that match our intention and what we are trying to do. So we know a few things about the marketing world, and I'll talk a little bit about this. And we know how to take products to market. I have a background in that, done it before. If you're better, you can go to market. If you're less expensive, you can go to market. If you're easier to use, you can go to market. If you can do all three, you can actually disrupt the market. We're going to talk about that as well as we go through this presentation. But what we really are is we are the most effective and efficient mechanism for the average person to invest in the stock market. We allow the average Joe, mom and pop, sitting at home, maybe you got $2,000, maybe you got 2 million. You're in that average Joe category. We allow you to invest like an institution. We've lived in a world that is dramatically improved by technology everywhere. The technology available in every industry, whether you're a self-driving car, whether you just hit a button to watch a movie, you don't have to go to the movies. You don't have to go down to the video store. You just hit a button. You can watch a movie. Heck, you can watch the darn thing on your phone. So we're talking about technological advances through the predictive machine learning that we have built. So make no bones about it. Like I said, we have three intentions. One, be better. What do I mean by be better? We want to outperform the markets, period. And by the markets, I mean the S&P 500. If you can do better than the conglomerate that is the 500 top companies, the S&P 500, then you're doing pretty good. We also want to do it on a real easy to use interface. It's real important to us that it's easy to use. So we want to be easier. We want to be simple. We want people to be able to use our platform, to have it intuitive to the person who knows nothing about trading the stock market. We also want to expose our clients to less risk. Remember, I talked about that diversification is not necessarily the best way to mitigate risk. Well, that's what we want to talk about. What do you mean less risk, Randy? Yeah, we want you to outperform the market with less risk. I use this as an example all the time. Can I beat the market? Yep, I can beat the market on the roulette wheel. I can go down that one time, put it on black, win, walk away. I outperformed the market. Now, how much risk did I have to take to do that? They don't tell you that out in the world of investing. They don't say, if you take all this risk, you can outperform the market. Oh, by the way, you could lose it all. We want to outperform the market while taking less risk. Those are the three things we set out to do. And then, oh yeah, there's one more. We want to be less expensive than anywhere else you can get it. We want our customers to pay less than they would pay anywhere else for the same type of service, same type of technology, and the same type of active involvement for the investor. That's what we want to have happen. That's our goal, and that's what we do it. And we've accomplished all four. So let's talk about those problems. I said we were gonna mention some problems. Well, we have statistically and over time we've been taught to believe, particularly up until 2020, that the market produced 9% return. It just did. It was like a machine. You just put your money in, you're 9% kicked out. Well, a lot of people that don't remember 07 and 08 or 02, they are experiencing this right now, or 87. It happens pretty regularly, but this is a problem for the average investor. They're just humming along, getting their 9, 10%, which is really probably more than that. But when you take the fees out of it, which we'll talk about too, it's a shock. See, another big problem that the average investor has is that they try to figure out, well, should I be in the stock market or should I be in real estate? Stock market, real estate, stock market, real estate. Well, the correct answer is probably both. See, over time, the stock market outperforms real estate. I know everyone's all like, well, what do you mean outperforms the stock market? I mean, it outperforms real estate. It does. It has a higher return over time. If you go back to the 20s till now, there's more money in the stock market to be made than there is in real estate. However, it comes with a price. That's the volatility and the risk. You end up with years like we just had in 2022 that you can't time. You can't tell. You don't know when it's coming. And all of a sudden you added 6 years till your ability to retire comes up. So we've been conditioned that that's just the way it goes. So we try to bounce around. We accept the fact that advisory fees are complicated. If you have a big name company, an Ed Jones or someone like that, go look at your statement. Try and figure out where all the fees are. You can't. One, they're not even listed. You can learn about that. And we know that the modern new generation of investors, they don't know what to trade. We saw a perfect example with the meme stocks and Robinhood in 2020. Everybody's out there getting rich, making money. Look at this. I'm buying, GameStop. Look at me go. I feel like an investor. Well, you're not. And those people that are professionals that are doing that are the ones laughing all the way to the bank. And then we've also been conditioned that if you're not going to do that, you just got to put your money in and leave it. Trust it. The market will eventually recover. It will all go up. If you have a professional advisor, you have been told you must leave your money in order for it to grow over time. That you cannot time the market. There's another one of those myths. You in fact can time the market, folks. It's important for you to understand that. There is a way to do it. It's called mathematics. So these are some of the problems we face. Now, today we have two choices. Right, we have two options. Well, if I want to participate, I go to a financial planner, I give them my money, and I pray. That's it. That's my choice. I give them my money and I pray. Hopefully they put me in the right things. Hopefully they move me in some stuff around. I've been running into people now for the past 4 or 5 months that are down 20 to 50%, having their money professionally managed by the experts who are telling them, no, just leave your money in. When if they'd have been on our platform, they'd have been out 5 months before that happened. So what's my other option today? I just learned how to do it myself. I become an expert in the Forex market. I know a few people that are experts in the Forex market. If you want to meet them, give me a call. I'll introduce you. Options, maybe. Maybe I want to trade Bitcoin. Maybe I want to do something different. Either way, there's a learning curve. You have to go learn. Most of us are too lazy to do it. So we'll play with it a little bit, like the whole Robinhood world in 2020. And then it gets boring. We're tired of it. We lost too much money. So we're out. So now what I'm going to do is I'm going to take the next chunk of this presentation and I'm going to talk to you about these two options. In particularly number one, that's where we're going to start. And that's the one we're going to pick on the most. So right now, if we say I'm just going to give my money to a financial planner, they're going to diversify me. They're going to put me in proper funds, and I'm going to get that nice, safe return over time. Let's take a look at that. Example number one, we're going to talk about mutual funds. All right? Mutual funds cost money. They actually have fees. So we're going to really talk about those fees, and we're going to see what they really are. And there's a handful of them. There's disclosed costs. These are the costs you see out on the window or on the advertisement. We charge 1% asset under management fees. We charge a management fee for the amount of assets you have on our platform. Those are disclosed. Usually they're fair. Most of the time it's anywhere, depending on how much money you have, from 0.5 percentage point to maybe as much as 2%. We also have hidden costs. We're going to talk a lot about those because guess what? They're hidden. They don't want you to see them. People don't want you to know they're there. And so if they're hidden, what do you mean, Randy? They're hidden. Well, they are. Number three, tax inefficiencies. There's a significant amount of tax inefficiencies involved in mutual funds. What do you mean, Randy? My money's in a mutual fund. It should be taxed good, right? No, it's not. You're paying taxes on it. And then number four is just no other word for it but sneaky behavior. Now, the information I'm going to share with you about these mutual funds comes from a study that Forbes did. Forbes got together with something like 10, 12 different universities and their finance departments. And they spent several years dissecting mutual funds to figure out what's really going on in the mutual fund space. Why are they not performing better than they should? And what's going on? Let's figure it out. So I'm going to break these down. I'm going to break all four of them down for you. We're not going to spend a ton of time on it. I want to make sure we're mindful of time. I know we're not here to learn about mutual funds, but it's important that you put your head around this. It's important that you really gather what's going on when you park your money in the professional institutions and they put it in a mutual fund. All right, these are all the costs that are disclosed. These are things that legally they have to tell you how much they cost when you go down and invest with a financial advisor. Front end load, back end load, Now, there's other things. I'm not going to go into explaining all these: purchase fees, redemption fees, exchange fees, account fees, plus all the other stuff that goes into the actual cost the advisor themselves is charging you. So now when you add all these together, on average, across the board, disclosed costs come out to about 1.19%. You're like, well, that's not very much, Randy. If someone's managing my money and it's returning well and the risk is being averted and they're doing a good job with it, I'm happy with 1.19%. I'll pay that all day long, not to be bothered by having to deal with it. Great. Well, that's one part. Now let's look at the rest of them. We'll spend a little more time on these. Let's look at the hidden costs. All right, let's just bring them up here and start to look at these, right? Mutual funds conduct trades on behalf of other investors, not just you, not just you. So when that happens, there's commissions that have to be paid. Even though they're trading on behalf of other investors, the cost gets incurred onto you, right? And there's basically 3 of these that happen: brokerage commissions. Funds will purchase securities at the ask price, sell at the bid price. If you don't know what that means, it's just backwards from a traditional auction. Think of an auction, it's the opposite way around. You say, I'm selling this, I want to sell this for $10. And the buyer says, well, I'll give you 8. That's a normal auction. Instead, they just go right and purchase it at the highest price. The price impact, right? So because they have to pay those broker fees, you end up with some of that. Now, when you think about when mutual funds trade, because their trades are often so large, I mean, sometimes they can be freaking huge. Their trades can cause the price of the security to move. Their buying can push prices up, their selling can push prices down. And so what they're doing is they're actually moving the market around in such a manner that causes you to lose money. On average, the average cost of that is 1.4%. Now you're probably going, maybe they couldn't figure some of that out, Randy. And 1.1 plus 1.4, I'm only at like what, 2.5? 2.5 is fair. They're managing my money, they're taking care of the risk, they're getting me great returns. I think 2.5 is reasonable. All right. There's more. Number 3, tax inefficiencies. Mutual funds are absolutely famous for tax inefficiencies. And I mean extremely famous. Let me give you an example of let me illustrate one for you. All right. So you walk down to the advisor, you give them your money and you say, invest this for me, and they buy a mutual fund. So now you, with your money, have just purchased a mutual fund. You bought the fund, you have it. It's made up of bunches of stocks, and in there's one stock. It's $50 a share. I mean, one stock, $50 a share, doesn't really matter to you. However, as you are sitting there looking at your mutual fund and you're watching all the hundreds of stocks that are in it, that particular stock drops to $40 a share. Have you made money? No, you've lost money. Again, you're going, well, but Randy, that's part of the game. That's not taxes. I lost money. Well, at this point, the fund decides to sell the stock, which happens all the time. They're like, that one's going down. We need to sell it. Right now, once that happens, officially, you've lost money. Again, not the end of the world. Not the end of the world. You've lost money. Okay, great. However, the fund originally bought the stock at $3 before you owned it. So did the fund make money or lose money? Well, the fund bought it at 30. It went up to 50 where you bought it, and then dropped to 40 where they sold it. So the fund made money. So now what happens is all the people that are part of that fund, they have to pay tax on that $10 a share gain. But Randy, I didn't gain $10. I lost $10. Well, sorry, even you, which is quite interesting that you have to pay tax on a gain that you did not get to participate in. In fact, you're paying tax on a loss that you took. Another 1.1%. Crazy, right? I mean, that's just insane. And the last one, sneaky behavior. Now, there's a whole bunch of these, and I don't want to jump too much into these, but I do want to talk about window dressing. Window dressing occurs in lots of funds. They do this often. And what these window dressings are is where they'll sell a poor performer right at the end of the quarter, and they're getting ready to report their quarterly performance. So they sell one that had a bad quarter and they buy one that had high performance. So now at the end of the quarter, that one with the high performance is part of the fund, and it shows as if it had been in the whole time. Window dressing. It's making it look much better than it was. The other thing they'll do is they'll shift the risk. They'll take big gambles prior to the recording, and they'll often shirk responsibility. This is where they're not being the proper fiduciary they're supposed to be for you, because selling of a fund or buying of something else has a bigger implication on maybe an institution whose money they're also being part of a management team. So if you're at a Schwab or a Fidelity, places like that. So they have to be financially responsible, but you can't be equally financial. You can't do it equally. And who's going to pay the bigger price, you or the institution? And then something they do with IPOs, where things that aren't making money and their banking partners want to make some money on it, they'll buy some things that they maybe shouldn't buy on some early stage IPOs. 2.5%. 2.5%. This is a big number. So now let's just look at the whole picture that I just took 4 minutes to give you a crash course in mutual funds. Crash course in mutual funds tells us that if we invested 100 grand and the market returns 9%, I should make $9,000. Simple math. Simple math. Right? However, if we take away the fees, that same 9 grand that you would have earned on the 100 grand turns into 2.7, 2,700, say 3 grand. That's the cost of fees. Now, if you compound that over 10s of 20s of years, you're losing a significant portion of your money just to fees. So that's option number one. How do I pay somebody to do it for me? Right? These fees come right out of your return. Not only are you paying a lot of money just to be as good as the market does, you're literally putting yourself behind the game. You're in the back seat. You don't have a chance. You're in that diversified fund to manage your risk. Well, would you rather take a little more risk? I don't know. Over 30 years, that's a 25% reduction in time. I mean, over 30 years, it's a 25% reduction. So what do you want to do? How do you want to participate? A 0.5% or 1% doesn't sound like a lot, but over time, it adds up significantly. So there's your first example why I would say mutual funds, bad. Easy enough. Okay. Example number 2. We've all been told that we must stay in the market. This is an example on how we help the average Joe. And we're going to talk a little bit about this. This is true. Over time, you will make money if you invest in the market and you just leave it there. No doubt. You put your money in the S&P 500. Over time, you will. However, they want you to stay in there during years like this. They say the cost of missing the best days, it's just too expensive. It's a common talk track. That's why they say you can't time the market. Another myth. You can time it, like we said, mathematics. And you can do it while risking less. So here's a few important things for you. Think of it like this. Buy and hold. If you stuck $1 million in the S&P 500 and you left it there for 20 years and didn't touch it, starting back in the late 90s, you'd have a little over $5 million today. That's pretty good return. Here's the argument of the advisor. If I'm an advisor, this is what I'm telling you. If you try to time the market and you take your money out and you only miss the 10 best days, if you miss the 10 best days, that 5 million after 20 years is only going to be worth 2.5 million. It's going to cost you 50% in 20 years if you try to time the market and you miss just the 10 best days. What they forget to tell you is the rest of the story. If you also miss the 10 worst days, that $1 million over that same time frame turns into 10.7 million. So the question becomes this: is it important to catch the best days, or is it more important to miss the worst days? Math would tell us it's more important to miss the worst days. Let's take a look at that. So here's the three differences. You got the 5 million right in the middle. That's buy it, hold it, never touch it, never take your money out, leave it for 20 years. You'd be sitting about 5 million. Try and time it. Miss the 10 best days, down to 2.5 million. However, in that time unit, you also miss the 10 worst days. Now you're sitting at 10.7. Again, I ask you, which is more important? And you say, Randy, but why is that such a big deal? Why does that matter? Well, there's a lot of people in that boat right now. There's a lot of people that didn't miss these worst days of 2022, and they're in a bit of a pickle. And if you look right now, this is where we're at, right? So you can see right now we're down around 20% or so, give or take a point here and there. And it's important for you to understand this. Right now, you're somewhere around 2.5, 3 years. If the market turned around today and went back to its normal performance, I don't think it's going to. Might. I don't see the world doing a bunch of great financial stuff in the near future, but whatever. If you think it's going to turn around tomorrow, in a couple of years, you'll be back to where you were before 2022 hit. You'll be back to where you were at the end of 2021. That's expensive. However, what if it goes down a little bit more? What if it goes down another 20? Now you're at 3 years, 6 years, 10 years. Every time the market goes down 50%, you need a 100% recovery to get to zero. Do the math. That doesn't work, Randy. Well, think of it like this. If you have 10 bucks and you lose half your money, you're down to 5. How much you got to gain to get back to 10? Another 5. There's your 100%. That's how it works. So if you're towards the end of your career, this becomes much more expensive than if you're in the beginning. It becomes a heck of a climb. Now you start taking gambling. Now you start trying to do things. Maybe I'll buy some real estate. Maybe I'll throw some money in this gas and other thing. Maybe I'll, just try some Bitcoin or some crazy thing. And we start scrambling because we're in panic mode. That's where people are at right now. People are panicking all over the place. They're trying to put their money in all kinds of crazy spots where someone's promising them 30, 40% returns. Remember, those don't come without risk. So what is the solution, Randy? If I'm going to try and do it myself, but I'm not going to learn how to do it. I saw what happened in the 2020 era with Robinhood folks, and you're telling me buy and hold ain't working. So what's the solution? Well, that's what we built. Ta-da. We say trade smart, right? Put your assets to work proper. What iFlip does, we've built, like I said, the world's first artificial intelligent investing. It empowers anyone to succeed like a professional investor. Automation's key. People want to be involved. They just don't want to do all the work. We all love to supervise. We don't like to, we want to watch the ditch be dug. We don't want to do the digging. And so that's the concept of what we're doing. We're digging the ditch for you. You just get to sit there and watch. And you just get to hang out, see it all happen. And how do we do it? We do it with AI and machine learning. Machine learning is a big deal. What do you mean machine learning? Isn't that an algorithm? Well, no, let's talk about that. So an algorithm, it's real important that you understand AI and machine learning is all done with algorithms. Just because something's an algorithm, though, doesn't mean it's learning. It doesn't mean it's AI. It's definitely not a machine that's doing any learning. An algorithm is simply a set of rules. It's a process, a set of mathematics to be followed. It's calculations and other problem-solving operations generally done by a computer. Now, we're not talking about HAL or the Terminator. We're talking about mathematics on a function. Let's use the stock market, for example. I'll give you one real simple algorithm. If Apple goes up $1 after the open, buy it. That's an algorithm. Super simple. Then you type that into the computer sees Apple goes up $1, it buys it. There's a lot of those. Lots of robos. That's a robo. If you want to know what a robo is, that's a robo. That's what they do. The problem with it is this. In order for that algorithm to change, a human has to go in and type it. A human has to go in and say, oh, no, dollar was the wrong number. It needs to be $2. So that's what happens when we do that. AI, however, machine learning is a little bit different. Once it's built, this is the important part. Once it's built, it does it on its own. It actually gets new data from other algorithms, not from a person. Those algorithms feed the data, in our case, every day into the machine that's learning every day. And when that machine learns, it then changes its rules on its own. Many of you know who Kelly is. Kelly doesn't go in and change the rules every day. The machine goes in and changes the rules every day. That's what it's designed to do. That's how it works. And so when we think about it from that perspective, what's better? An algorithm that has to be changed by a human, that also has emotions, also has opinions, also has all kinds of other thoughts going on, could be having a bad day. Maybe they're hungover that day, they type it in wrong. Artificial intelligence has no opinion. It doesn't care. It doesn't care who the president is. It doesn't care what's going on in other parts of the world. It doesn't care how much gas costs. It has mathematics behind what's going on and a lot of different algorithms feeding it information. And then it changes its own rules. That's the big difference. Now, who built this? Many of you that are listening to this probably already know. Kelly Korshak is my co-founder. He is our CIO, and he is the one that developed the AI. He's a pretty smart dude. Went to Stanford's physics program when he was 16 years old. Graduated, managed money on Wall Street for some of the elite of the elite. When he was at Deutsche Bank, he was the risk manager there. And the bank gave him $6 billion to manage. How did he do it? With mathematics and a team of folks from MIT with mathematics degrees. He just told them what to do and they did it. They were his version of AI, although they weren't artificial. They were his just eye. He had the intelligence only. So that's the idea. And that's what Kelly did. And when I met Kelly, he just said something simply, Randy, the world doesn't understand how it works. The average person absorbs all the risk and Wall Street passes it to them and skips the risk. We manage risk. I'll say it again. We manage the risk. The AI does. So it's important that you understand someone pretty smart developed this. All right. I'm just the talking head. So let me give you a couple examples. This is the SPY Plus. And you look at the performance here, you can see the software in orange trading the SPY Plus Smart Folio. We call them smart. Why? Well, because they're smart. The AI is doing it. If you go back to 2017 until literally you can see this is November, this maybe a few weeks ago, the AI trading Apple and the S&P 500 against the S&P 500, that's the market. Are we beating it? Yes. Do we always go straight up? No. This is a very popular one. This is a root, a foundational smart folio that many of our clients use. And this is just real performance. You can see how it works. What if you put 10 grand in 2017 on our platform, you'd have almost 25,000. If you just stuck it in the S&P, you'd have 16. So yes, it does go up. However, we can help it go up more by what? Skipping the dips. Let's look at just the straight S&P 500 head to head. Same concept just for this calendar year. We're down. Our 10 grand this year, if it was only in the S&P 500, would be 9,600. That 10,000 in the S&P 500 would be at 8,000. That's a huge differentiator. It's a big deal right there. I hope you guys truly understand what you're looking at. That flat line means we're skipping these worst days. Skip the dips. Skip the dips. Let's look at it in a more practical term. Now, I hope you can see my cursor. I'm looking over here at another screen, but if you look right here, December 28th of 2021, that red circle right there, that little red dot right by my cursor, that is where the AI sold the S&P. Sold it, skipped it all the way down. You see the blue is where it tried to buy. You saw the little blip on the previous screen. Then it quickly sold again because it continued down. Tried to catch it on the way back up, got a little bit, and then got back out to skip the rest of it. So We're not day trading, folks. If you look from that blue arrow, that's at the end of December 2021, almost a year ago. 1, 2, 3, 4 trades. 4 trades. 4 trades. And in 4 trades, we are $1,600 ahead of buying and holding the thing we are trading. That's the whole idea. Now, if you run this backwards and you look at what's gone on in the past, remember I mentioned 87 and 1990 and all these different things that happened in the crisis of the world. When you look at this, what's circled right there is where we had live money trading. So during the end of 2018, that big trade war where Trump was getting all over China, that proved to make the market go down 20%. We were down 3. During COVID, we were down 9. We're down less than that this year. And so when you think about it, when the market's down 30, being down 9 is a good thing. It's important for you guys to understand that. And if you go all the way back to the big 2007 crisis when it was down 57, we were only down 12. You're talking decades to get back at that point. Now, how does the interface look? For those of you that don't know or haven't seen it, this is the simple home screen. You're just looking at where it shows you the value, how much money is allocated, what's in the open P&L. Actually, I think this might be one of my accounts. And when you look at it, you can see that the market goes up and down. And I want to point something out right here. I'm going to use my cursor again. I hope you guys can see it, where it says down a little over 10 grand. Well, if you look at it this way, manually trading, that means Randy trying to trade himself, is down $11,000. And the AI is actually in the positive for the year. Maybe I should, listen to myself and use my own software. Probably be a lot better off if I did that. I see you guys, some of you guys are laughing at me. And you should. It's pretty funny. So here's what I want to do now. We're at 35 minutes. I told you guys it'd be 45 or so. That's the idea. I want you to do this. If you don't have the software, or if you're part of our company and you're not set up, scan that. Scan that QR code and get a demo. You'll get on Lee's calendar. And what that will do is that will get you a private time for him to walk you through the software. Might take you 30 minutes is all, and you'll have it all ready to go. You can get it all set up. You can get it all going. Doesn't cost you anything to do that. However, if you scan that, that's our gift to you of time. One of our experts, his name's Lee Gearhart, he will walk you through what the software does, how it works, and I promise you he can show any one of you how to use it in 30 minutes or less. It's that simple. Remember, you got to do 4 things. You can't just be better, can't just be cheaper, can't just outperform the market. You also have to be very easy to use. Okay. And if you're not sure of that, you're like, I don't know, man. That's a lot, Randy. I don't know that I want to do that. Well, then scan this one. At least go to our website. Go check it out. See what it's all about. Get your feet wet. Look at the little graphs I showed you on the S&P 500 and on the SPY Plus. There's a bunch of those in there for all the smart folios. Go check them out. Give them a look. Give it a scan. Check out the website. Come see what we're all about. You won't be disappointed, especially if you have money currently invested somewhere, or if you have maybe a old 401k from an old job that's just laying there not doing anything, or you left it with the company to manage. We can do a much better job for you than that all day long. So one of the last things I'm going to talk about, I'm going to do this real quickly, is, well, Randy, how do you charge? Oop. So, Randy, how do you charge? Well, pretty simple. We have a simple scale. It's as little as $5 a month, or you can pay for the whole year and get it for $50. Remember all those fees we talked about? They don't exist. No commissions, no trade fees, no back end stuff, nothing, no hidden fees, no tax, none of that. Flat monthly subscription, just like iTunes. And that'll get you up to $10,000 for $5 a month. And you can scale it all the way up. And once you get to 100K, you're up to $147 a month forever. That's it. We have people on this platform that have millions. That's yes, more than one on the platform, and they pay $147 a month versus all those asset fees. Now that 1% asset fee doesn't sound like such a good deal, does it? That's a huge part of our UVP. Very easy to use. In fact, you can even put it on a credit card, and I can maybe talk to your accountant and show you how to deduct it, make it a tax deductible expense. So all of these things play into that. Now, again, scan the QR codes. Hopefully you guys did that. Hopefully you get an appointment with Lee. Hopefully you come join us. At least come give it a look. We are doing way better than your traditional financial planners, and we're way easier than you trying to actually do it yourself. So everybody, like I said, my name is Randy Tate. I want to say thank you. You can find us on our YouTube channel, iFlip. You can find us on Instagram, Twitter. You can follow me on Facebook, or just go to our website. Come check us out. Come get a demo. You'll be very happy that you did. Now, Aaron, before I sign off completely, anybody, do we have any questions or anything else I need to address?
Yes, this is a question that we get very commonly. And just to set the stage for this, at iFlip, you can pay your fees out of your brokerage account in addition to paying it like on a credit card, just like Randy said. Randy, you have very a strong opinion that one is way better than the other. Can you tell us a little bit about that?
Absolutely. There's several reasons. If you pay for it out of your account, you're depreciating the asset you're trying to grow. Even on the small fees that we take, it's going to depreciate it. And over time, the compounding cost of that is significant. It may only seem like $5 or $25 or $47. It's not very much, Randy. Just take it out of the account. It's easier. Yes, it's easier. I'll grant you that. However, over time, it's extremely expensive. You're going to be paying not just the $47, you're going to be paying the money that the $47 would have earned. And when you start doing that, it gets very expensive. Put it on a credit card, pay it off every month. Talk to your accountant. I'm not an accountant, but if you talk to your accountant, you can tell them that, hey, there's an affiliate platform there. They may pay me or give me a referral. And because we may do that, you can write that off. There's a tax, you can deduct the tax, or you can take a compounding loss. Oddly enough, most people still pay out of the account. However, I want to encourage everybody not to. And it's better for us if you pay out of the account. Why? Because we don't have to pay the fees on the back end of the credit cards. So why would I encourage you to pay in a manner that actually costs me money? Because we want to empower everyone to preserve, protect, and grow their wealth. So those are the two main reasons, Aaron, that I give people.
Awesome. Thank you. I 100% agree. One of the first things that attracted me to iFlip in the very first place is the fact that you could trade out of, or excuse me, you could pay fees out of on a credit card instead of cannibalizing your own buying power.
Yeah, exactly.
Yeah. So I totally agree with you there. Another question that we get commonly is that you talk a lot about mutual funds in your presentation, but is that the same as ETFs? Because index funds and ETFs are more popular these days, and they show a much lower fee, like less than 1%. Like, isn't that a pretty good deal then? Mutual funds are expensive, yeah, but aren't index funds and ETFs kind of a good deal?
Compare side by side comparison. Yes, ETFs are a better deal. I mean, that's the simple answer. Why? Because they don't have there's a lot of the fees that aren't out of it. They are a lot less expensive. They still have fees though. There's still fees that come out of them. They still cost money to be part of, and they still partake in some of the behaviors, but they're not as egregious as a mutual fund. So their intention is the same, though. Their intention, both of them, is to diversify you. Now, an ETF may be in a sector, maybe. A mutual fund could too, but they have different parameters around how they're created, but they're designed to mitigate risk through diversification and possibly take advantage of some upswing or a trend. But yes, ETFs are less expensive than mutual funds. You are correct in that. And from my opinion, they are better and they're not bad. ETFs, you definitely would rather have an ETF like the Spider than a mutual fund like the Contra Fund of Fidelity.
Gotcha. And a last one here. We get this one quite a bit often as well. So we got all these super common ones. There was a lot of talk in the presentation about saving money, right? Saving in fees, skipping the dip, which prevents losses. Now, how does saving all that money translate into growing money, or let's face it, we all want to build our wealth a little bit faster than we would have otherwise. So how does saving all that money translate into that?
Yeah, real simple. The think of it like this. If you skip the dip, like I'm talking about, the fact that you're skipping that dip means you have more money to buy when the market's down low. If you have the same amount of return going on and you have more money in there to start with, it just by nature over time, it compounds even greater. Skipping those dips is extremely important. By skipping them, you have more money to buy the stock when it's lower. Simple. It's as simple. It is as simple as that. You want as much dry powder as you can possibly have to buy the stock when they're at a low rate.
Okay, and we just got this question in. Is there anything new coming to iFlip in 2023? Anything you want to share with us? Give us a sneak peek.
Oh man. Yes, there's a few new things coming. No, I'm not letting the cat out of the bag.
Okay.
I really want to, but then I would have people yelling at me.
Okay.
Yes, we've got a handful of stuff. Our roadmap is extensive. I'll give you a couple.
Okay.
Dang it. Okay, just because I want to. I guess I can do that. I'll give you some little ones. These aren't big ones. These aren't things that are going to go crazy. There's going to be a couple of new smartfolios that Kelly's developed.
Ooh.
There's one piece. We're going to put in the ability for you to automatically deposit on a monthly basis. So
Nice.
You can treat it like a true retirement account and just automatically funds itself.
Mm-hmm.
We're also going to be doing a lot of streamlining of the onboard process. We're going to make it even simpler. April, we will be having an event ourselves in April. Mark the date, April 2021. We will be in Dallas, Texas. Put it on your calendar right now. And we will be hosting another event like we did the Mastering the Markets event this October. So there's 3 things that are coming, Aaron. And I didn't give you a couple of the big ones. I know what you want me to probably say, but I'm not gonna throw any of that stuff out. There's a lot coming. There is a lot coming. We've for everybody that didn't know, we've closed the first part of our Series A funding round. So we've ramped up our development team by a lot, and we're creating a lot of new stuff right now. Think of it this way: the cooks are in the kitchen, getting ready to serve some really good stuff come January.
Awesome. Well, that does it for this special edition of the iFlip presentation. Please thank you so much, Randy, for joining us and giving us your time to answer all these questions and give us the overview. As always, if you've enjoyed this content, please click the like button and subscribe to the iFlip YouTube channel. Turn on the notification bell so you don't miss any more live streams just like this one. And we'll see you on the next episode of the AI Circle, coming to you Wednesday from the iFlip YouTube channel. Stay tuned. Good night, everyone.